Okay, picture this. You're in your GST exam. You see a question on TDS. You know the rate, you apply to the invoice value, and you move on, thinking, yes, easy marks. But what if that simple calculation was an ICAI trap? Well, that's exactly what we're diving into today. The hidden twists in Section 51 that can make or break your score. Let's get right into it. So imagine this exact question on your paper. A government agency, a works contract, and a payment of 2,95,000 rupees. And here's the kicker. It includes GST. Now your brain probably jumps straight to the TDS rates, right? But hold on. What value are you actually applying that rate to? This right here is the first and honestly the most common trap they set. So this is the fork in the road you face in the exam hall. On the left, the common mistake, slapping the TDS rate on the full invoice value, 2,95,000. On the right, the path that actually gets you the marks. First, you got to strip out the GST to find the taxable value, which is 2,50,000, and then you apply the TDS rules to that number. The big question is, how do you know for sure that's the right way? Where does the law actually say this? Let's be absolutely clear about this. This confusion between the total invoice value and the taxable value is a classic ICAI move. It looks so simple, but this is exactly where marks are lost year after year just because this one concept isn't crystal clear. You know, the entire solution, the key to grabbing these marks, it all comes down to understanding how the law defines one single word. Value. It's not about some crazy complex calculation, it's about reading the section precisely, and that's exactly what we're going to do right now. But before we dissect the law itself, let's take one quick step back and build our foundation. What exactly is TDS under GST, and, why does the government even have this system in the first place? Because if you understand the why, remembering the what becomes so much easier. So in simple terms, TDS is basically a pay-as-you-go system for GST. Instead of the government waiting around for the supplier to file returns and pay their taxes, it just tells the recipient, the person making the payment, hey, before you pay the supplier, just snip off a small piece of the tax and send it directly to us. It's a tool to get tax revenue in the door early. So why do this? Well, there are 4 really good reasons. First, it gives the government a nice, steady stream of tax revenue. Second, and this is the really smart part, it creates a solid audit trail. The payment is recorded, the deduction is recorded, it's all there. Third, that trail helps prevent tax evasion. And finally, it helps pull more transactions and businesses into the formal tax system. Now, a super important point here. Do not, I repeat, do not confuse TDS with its close cousin, TCS. They are not the same thing. TDS, our topic today, is Section 51. It's deducted by the recipient. TCS is Section 52. It's collected by e-commerce operators, like Amazon or Flipkart, for their sellers. Totally different sections, totally different mechanisms. Okay, foundation is laid. We get the what and the why. Now it's time for the main event, decoding the heart of the matter, Section 51. We're going to break down the core rules, and more importantly, I'm going to point out the exact traps you need to look out for in the exam. First things first, who is even responsible for deducting TDS? It's not just anybody. The law has a very specific list, which I like to call the Deductors Club. This includes government departments, both central and state, local authorities like your municipal corporation, other governmental agencies, and anyone else the government notifies. This is so important. If the person paying isn't in this club, Section 51 doesn't even apply. Okay, next up, when does this whole rule even kick in? It only applies when the total value of a taxable supply under a single contract exceeds 2,50,000 rupees. Remember that word, exceeds. If the contract value is exactly 2,50,000, no TDS. It has to be more. This is an absolutely critical threshold. And what are the rates? Well, they're super straightforward. If it's an intrastate supply, so within the same state, the deductor cuts 1% as CGST and 1% as SGST. If it's an interstate supply between 2 states, it's just a flat 2% as IGST. So either way, it's a total of 2% tax getting deducted, just split up differently. And here it is, the answer to our opening problem. This is the exact line from the law, the explanation to Section 51. This is the sentence that saves you marks. It states black and white that for TDS, the value of supply is the amount excluding all the GST components. It's not an interpretation, it's a direct command. So let's bring it all back to our first question. The invoice was for 2,95,000, which included GST. The taxable value, when you back calculate, is 2,50,000. Now remember the rule? TDS applies only if the value exceeds 2.5 lakhs. Since our value is exactly 2.5 lakhs, no TDS is required at all. See how that one word exceeds and the definition of value just completely flipped the answer? This is precisely how you need to think.
Okay, so you've mastered the value trap. You're feeling confident. But wait, there's another major trap that ICAI loves to set. There's a scenario where even if the contract is for, say, 10 lakh rupees, TDS is still not required. This brings us to the very tricky location proviso.
Okay, this slide is crucial because ICAI loves to twist this rule. Look at the first row: supplier, place of supply, recipient. Everyone's in Maharashtra. TDS applies. Simple, right? But now look at the second row. The supply is still happening in Maharashtra, but the recipient is registered in Gujarat. Because the recipient is in a different state, the rule kicks in and bam, no TDS is deducted. The key takeaway: if the location of the supplier and the place of supply are in a state that's different from where the recipient is registered, it breaks the TDS chain. Awesome. We've cracked the core rules, we've navigated the major traps. Now let's just quickly walk through the procedural side. I mean, how is this tax actually deducted and paid? And what happens if you get it wrong? All right, we've arrived at the final boss level of exam traps for Section 51, the refund rule. What happens if the deductor makes a mistake? They deduct too much tax, or maybe they deducted it when they weren't supposed to. Can they just ask for a refund? Here it is, the critical line from Section 51, subsection 8. You have to read this carefully. It says no refund will be given to the deductor if that amount has already been credited to the supplier's electronic cash ledger. This is a massive point. And this boils down to a very simple, very powerful takeaway for your exam. Think of the credit transfer as a one-way street. The second the deductor files their GSTR7 and that credit lands in the supplier's cash ledger, the deductor is out of the picture. The money effectively belongs to the supplier now. If there is a mistake, only the supplier can claim a refund. The deductor can't pull it back. Tax collection at source, or TCS, under Section 52. And I promise you, by the end of this quick explainer, you'll be total masters of this section. You'll be ready for any question ICAI decides to throw your way. So let's kick things off with a classic exam problem and see if you can spot the trap. All right, here's a classic exam-style question for you. An Amazon seller makes a sale for 11,800 rupees, and that price already includes 18% GST. Now Amazon, as the electronic commerce operator, has to collect TCS. So the big question is, on what value are they going to collect it? Be careful here. If you think the answer is super obvious, you might just be walking right into a trap. The secret to avoiding it is buried in the law. So here's our game plan, our 5-step roadmap to completely untangle this whole concept. We'll start with that common trap. Then we'll decode the main rule in Section 52. After that, we'll run through the ECO's compliance checklist, see how the supplier actually gets their credit back, and finally, cover the notices and penalties involved. Let's jump right in. So where does all the confusion come from anyway? Well, it's all about the 3 main players in this little game. You've got the supplier, the e-com like Amazon, and of course, the customer. Let's quickly break down who does what. Just think about it for a second. A seller lists their product on Amazon. A customer comes along and buys it. Amazon collects the money from the customer and then passes it on to the seller, right? But only after taking its own commission. Now, with millions of these transactions happening every single day, the government needed a trail. They needed a way to track all this value right at the source. And that is exactly why Section 52 was brought into the picture. So, let's decode the core rule itself. Section 52 is basically the government's answer to this huge tracking problem. It makes it mandatory for the e-commerce operator to collect a tiny percentage of tax at the very source of the transaction. The law specifically points its finger at the electronic commerce operator, or ECO. An ECO is pretty much anyone who owns or runs a digital platform for e-commerce. And according to Section 52, subsection 1, if the ECO is the one collecting the payment from the customer for the supplier, then the responsibility to collect TCS falls squarely on their shoulders. Okay, now I need you to focus on this definition: net value of taxable supplies. This phrase right here is, without a doubt, the single most important part of this entire section. And you guessed it, this is where marks are lost over and over again. It's the total value of all taxable supplies made by all sellers on that platform, but, and this is the key part, reduced by the value of any supplies that were returned during that same month. So here's how the math works out. You take the total value of all the taxable supplies made through the platform, and you subtract the value of any stuff that got returned. What's left is your net value. And here is the crucial exam tip. Listen closely. TCS is always calculated on this net value, which is the value without the GST. Never, ever, ever calculate it on the price that includes GST. That's the trap.
The law also carves out a really important exception. Services that fall under Section 9, subsection 5, are totally excluded from this calculation. Why? Because for these services, like taking an Uber or ordering from certain restaurants on Zomato, the ECO is already on the hook for paying the entire GST amount themselves. So, to avoid taxing them twice, these services are kept out of the TCS net completely. This is a key point you have to remember.
Okay, so we know what value to tax, but at what rate? Well, the law says the maximum rate can be 1%, but the rates that have actually been notified are much lower. For a sale within the same state, an intrastate supply, it's 0.25% CGST and 0.25% SGST, which adds up to a total of 0.5%. For a sale between states, an interstate supply, it's just a flat 0.5% IGST. So the effective rate you need to remember for your exams is simple. It's 0.5% of the net taxable value. And now we can finally solve our opening question. The total price was $11,800, which included 18% GST. So first things first, we strip out the GST to find the taxable value. We divide by 1.18, and that gives us a nice round 10,000 rupees. This is our net value of taxable supplies. Now we just apply the TCS rate of 0.5% to this 10,000, and the answer is 50 rupees. So the crucial takeaway here is that Amazon will collect just 50 rupees as TCS. Okay, so we know what to collect and how to calculate it, but what about all the paperwork and the deadlines? Let's switch gears and look at the ECO's compliance checklist, all the due dates and procedures they have to follow. The compliance deadlines are actually pretty straightforward. The ECO has to pay the TCS they've collected over to the government by the 10th of the next month. Easy enough. They also have to file an electronic monthly statement, which is GSTR 8, giving all the details of the supplies by that exact same date, the 10th. Then there's an annual statement, which is due by the 31st of December of the following financial year. And just remember, the commissioner does have the power to extend these dates if they need to. Now listen up. Pay close attention, because this is a major ICI trap zone. What happens if the ECO makes a mistake in their monthly statement? Well, they can fix it. But there's a deadline. The law says they can't make any corrections after the 30th of November of the next financial year, or the actual date they file their annual statement, whichever is earlier. Look at this timeline. If they file their annual statement on October 15th, then their deadline to fix any mistakes is October 15th, not November 30th. This whichever is earlier clause is exactly where students lose easy marks. Don't let that be you. So the ECO collects the tax and pays it to the government. But what about the supplier? Is this just an extra cost for them? Absolutely not. Section 52, subsection 7, gives us a mechanism for the supplier to get this exact amount back. You know, the process is actually wonderfully simple and totally automated. As soon as the ECO files their monthly statement, GSTR 8, the TCS amount they collected on behalf of a supplier automatically shows up in that supplier's GST portal. The supplier can then claim that amount as a credit, and it gets added directly to their electronic cash ledger. They can then use that money to pay their future GST bills. It's basically like an advance tax that was paid for them. Right, last part. What happens if things go wrong? Let's take a quick look at the powers the tax authorities have and the penalties for not following the rules. This is all covered in sections 52, subsections 12 to 14. So who has the authority to start asking questions? Well, the law gives this power to a tax officer, but it can't be just anyone. It has to be at least a deputy commissioner. This officer can issue a notice to an ECO demanding all the details about supplies made through their platform, or even asking for information about the stock of goods that suppliers are keeping in warehouses managed by the ECO. And how long does the ECO have to reply? The law is very specific about this, and this is a perfect kind of detail for a multiple choice question. The operator has to provide all the required information within 15 working days from the date they get the notice. And note that it's not 15 calendar days, it's 15 times working days. And what if the ECO doesn't provide the information within those 15 working days? Well, they can get hit with a penalty, and that penalty can go up to 25,000 rupees. Just as a side note, this penalty can be applied on top of other actions under Section 122 of the Act, but you really don't need to stress about that for your interest syllabus.